எழுநூற்றி தொண்ணூறு. கொஞ்சம் சேர்ந்த மாதிரி 1000 ரூபா போட்டுட்டு 1000 ரூபா தருவா இல்ல கொஞ்சம் சேரட்டும் அதே மாதிரி தான் வச்சுறீங்களா?
Right. Okay, guys, welcome to the TRG. This is our third class together. So the plan for today is we will finish off this mixed bag. Okay, so mixed bag 2, which is basically a few more questions, right? About 12 more questions. And then we will do a mock exam. Okay, so basically a paper that will look just like your exam. So it will start off with the section A, 35 questions, and then we will have the section B, which is the MTQs. Okay, so those of you who attended any of my lectures, that will be the mock exam 2 that you sat for, which we didn't discuss. Okay, so we will be doing a full discussion of that particular mock paper. So it will benefit those who did the paper as well as those who didn't do the paper. Okay, so for those of you who didn't do it, once we're done with the mixed bag 2, the questions that we do, basically it will teach you, the format of a particular paper and how you can go about answering questions at your exam. Okay, because when it comes to your paper, there is a particular order in which things happen. Okay, so you will notice that, for example, one of the things you will notice is section A tends to have only about maybe say 50% of calculations. And whenever the calculation is there, there tends to be a situation where you end up spending a lot more time for that particular question, although it's only worth 2 marks. Okay, so you will see, the smaller details of, questions in your papers and how you should go about sitting for it. Okay, so definitely this is an important area, right? Because if we don't do this, then definitely, you will know how to do answers, you will know how to prepare your statements and all that, but you won't be able to apply that to the exam situation, which is a bad sign. Okay, so that's the reason why we will be doing that. Right, so last week we stopped with the 11th question, which is the benefits of activity-based costing. So let's move on to 20.12. It is something to do with IRR, internal rate of return. So I'll let you have a go at it. It's very simple. You just have to use the IRR equation and try to find the IRR. Okay, so have a go. See if you can get the answer. And if you have the answer, drop it in the chat. So IRR equation, you should be knowing it. It won't be given to you at your exam. You should basically memorize it. Today is the 16th, right? So next week is the 23rd. I believe is Vesak. So I'm not sure if we will have the TRG on that day. But anyway, even if we don't have the TRG, it won't be a problem because unlike other months, usually in months where we have TRGs, what happens is we only have 4 weeks. But this particular month, for your benefit, there are 5 Thursdays. Okay, so even if there is no TRG on the 23rd, you won't be missing out on anything because we anyway have the 30th to have the 4th class. Good evening, Arundhati. Okay, so with regard to whether we will have the TRG or not, please make sure that you, keep an eye on the group, on the Telegram group, because I'm honestly not sure. I haven't checked also. So in case we don't have it, you have a heads up and you know that it's not there. If you're having it also, you will know. Okay. $17.6. That's an answer. Okay, good. So I have written down the IRR equation for you. Okay, in case you can't remember it. But again, I'm emphasizing the fact that you have to know this equation. It's not given. Anybody else with answers? Do we have a mock exam? No, Arundhati. The TRG, we won't have mock exams. Okay, we will be going through a mock exam paper. Okay, but I won't be like asking you to do a mock exam and, marking it and things like that. We won't be doing discussion. Yes, if you have come to my MA class that I had recently. Okay, so we had a batch, a weekend batch. If you had come for that class and you did mock exam too, we didn't have a discussion for that paper. We just have the marks for that particular paper, right? So yes, that mock exam we will discuss. Okay, so even if you haven't done that paper, it doesn't matter, because still for all, it is a mock exam. So that will anyway benefit you. Okay, so Husna is saying 22.7. Okay. We have different answers. So the first thing that we have to decide in this question is which two rates are we going to use? 17.62. Okay, so that is A, you're saying, Asya? Okay. Right. So it's like this, right? So this is actually a little different situation, because usually when they ask us to calculate IRR, they give us two rates and two NPVs. It's easy. We can, just put it into the equation and get IRR. But here you have to be a little careful in the sense that they are giving you three rates. So we have to choose the best rates. Now we know if we want to get an accurate approximation of IRR, the NPVs, the two NPVs that we choose, one has to be positive, one has to be negative. Okay, so for sure we know we have to use this 10,800 negative. No two words about that. That's the only negative figure we have, right? Then the next question is, are we going to use 69,700 as the other NPV or 16,000 as the other NPV? Both of them are positive. Okay. Now remember this, right? If you want to get a good approximation of IRR, okay, let me just show you, draw a small graph over here. So usually this is the NPV graph. Okay, so NPV will be here. The discount rates will be here. Usually the situation is NPV will keep on dropping as as the discount rate keeps on increasing. Okay, so in IRR, what are we trying to do? We are trying to find this point, right? The point where this line meets the x-axis. That's the point where the NPV is 0. So that is the discount rate which we want to find. This is only IRR. Now, if you want to have a good approximation of IRR, it is best for the two NPVs that you use to be as close as possible to the IRR point. As close as possible. Okay. So here you can see there is a 10,500 negative. So suppose, let's just say that is this point. There is a 16,000 positive. Let's assume that's this point, and a 69,700 positive, right? So these are the 3 points that we have: 69,700, 16,000, and a 10,500 negative. Okay, so it's very clear that the only 2 points that are closest to the IRR is number 1, this 16,000, and number 2, this 10,500. That is a discount rate of 14% and a discount rate of 20%. Okay, so those are the two rates that you will have to use. Okay, so that is the important decision that you will have to make over here. Okay, if you get that, the rest of it is just the normal IRR calculation. So let me just finish it off. The lower rate will be 14 plus NPV at the lower rate is 16,000 positive, divided by NPV at the lower rate, again 16,000, minus NPV at the higher rate 10,500 negative. So this goes as minus 10,500 into the higher rate, which is 20, minus the lower rate, which is 40. Okay. So you can put that in your cal and see what the IRR will be. Make sure when you're putting these numbers, don't put the percentage sign when you're calculating IRR. So yes, that should be 17.6%. So that's 8. Okay. So all of you, the rest of you are getting different answers. because you might not have selected the two proper NPVs. Okay, so that is why you're getting different answers. And honestly, that like your examiner won't give you like a, even like a mark for that, because although you chose the wrong figures, you have used the correct IRR equation, right? But just because of that, they won't give you the mark, because they expect you to know that the best two figures to use are the two figures closest to the IRR approximation. Okay, so that's important. Okay, you can take this down if you haven't. Those of you who've already taken it down, you can try out 20.13.
إلا بما شاء وسع كرسيه السماوات والأرض ولا يؤوده حفظهما وهو العلي العظيم.
Okay, so I hope you guys have taken it down. What do you think is the answer for 20.13? Okay, so it's saying a company uses production labor hours to absorb its fixed production overheads. Now, that is what most of us tend to do, right? We use labor hours to absorb our fixed production overheads. A strike by its workforce results in a loss of 30% of the period's budgeted production labor hours. Okay. So what they're saying is, if we budgeted our people to be there to work for us for say 100 hours, because they have some kind of a strike that the workforce has started, we don't get the 100 hours that we budgeted. We only get 70% of that. So we only get 70 hours of the work time. Okay, 30% is lost because of this strike. Which of the following variances will occur as a result of the loss in production labor hours? Okay. So first is saying you're going to have an adverse fixed overhead capacity variance. Okay, actually, when I see that, it seems to be correct. Okay, because I have budgeted, let's say, 100 hours of work. I have budgeted 100 hours of work, but the actual hours of work that I get is only 70 hours. So I have budgeted more, I'm getting less. My people are not willing to work for longer. They're striking. Okay, so that is bad for my capacity. Capacity is about whether your people are willing to work longer if you ask them to. In this case, they are not even willing to work for the number of hours that is budgeted. So that is definitely a bad sign for your capacity. Okay, so A seems to be the answer. Let's just read the others as well. An adverse fixed overhead efficiency variance. Anything to do with efficiency is to do with speed. Okay, it's to do with how fast they are working. So if we say adverse, we are saying they are working slowly as opposed to our budget. But over here, it is not about whether they are working fast or slow. Maybe in the remaining 70 hours, they were actually fast. It's the fact of the matter is that they are not working for a portion of the budgeted time. It's not about the fact that whether they're working faster or slow. So both the efficiencies are completely out. Okay. And adverse direct labor rate variance means we are paying them. It's something to do with the amount that we are paying them. So if it's adverse, that means we are paying them more than what we budgeted. Okay, adverse for the company, right? Don't think it's bad for the employee. If we pay them more, that is actually good for them. But we are talking from the company's point of view. So if you're talking about an adverse labor rate variance, it means we are paying them more than what we should be paying them. That's why the rate variance is adverse. In this situation, we are not talking about how much we pay them at all. Okay, so the answer there will be A, adverse fixed overhead capacity variance. Okay, so you can try out 20.14. That's a very simple one, but you need to do the calculations. Okay, so calculation is easy, but it might take time. We have answers. Sorry about that, guys. I happen to have a drop-in connection. Okay, so let's do this. It's saying a firm with current assets of 40 million and current liabilities of 20 million buys 5 million of inventory on credit, which increases its inventory level to 10 million. Okay, what will be the effect on the current ratio and the quick ratio? Okay, so we need to calculate current ratio as well as quick ratio, both before and after this inventory purchase. Okay, so let's go for the current ratio first. Okay, so before the inventory purchase, right? If you look at before, current ratio means current assets divided by current liabilities. So we know that the current assets was 40, current liabilities was 20. So the current ratio before, it was 40 divided by 20, which is 2. Okay, so that's the current ratio before. Then if you look at after the inventory purchase, we have now current assets worth 40. And in addition to that, we are buying 5 million worth of inventory on credit. So that means inventory is a current asset. So we will have to add 5 million over here and divide it by 20, plus we are buying it on credit. So that will add up to current liabilities. So you have to add a 5 over here as well. Okay, so that will become 45 divided by 25, which is 1.8. Okay, so before it was 2, after it is 1.8. If you want to know the percentage change, then you have to take the final figure, which is now 1.8, minus the initial figure, which is 2. Divide this by the initial figure, which is 2. Just put it this way. Okay, so that into 100. Okay, so into 100, that will give you the percentage change, right? So 1.8 minus 2 divided by 2 into 100. So we're talking about, let me check, 10%. Okay, so current ratio from 2, it has become 1.8. So it has reduced by 10%. Okay, so same thing we'll have to do with the quick ratio. So quick ratio means you will have to take the current assets minus inventory divided by current liabilities. Okay. So they are saying here we buy 5 million of inventory on credit, which increases its inventory level to 10 million. Okay. So that means before you bought the 5 million, you had 5 million worth of inventory. That's why when you bought another 5 million, the total inventory became 10 million. Okay. So before will be 40 minus the 5 million worth of inventory that you have divided by current liabilities, which is 20. Your quick ratio before will be 1.75. After, what happens? Now you have 40 million plus 5 million worth of inventory. So that is 45 million. But you can't include inventory, right? You have to remove it completely. So 45 minus 10, because now we have 10 million in our inventory balance, right? So 45 minus 10 divided by the current liabilities, which is 20 plus 5, which is 25. Okay. So this you multiply it by 100. That will be 1.4. Okay, so now get the percentage change. The final figure is 1.4. Initial figure was 1.75. So final minus initial divided by the initial, which is 1.75 into 100. Right? So that will be, we're talking about 20%. Okay, so you can see quick ratio was 1.75, which reduced to 1.4. The difference is 20%. So again, this reduced by 20%. Okay. Correct. So most of you have got the answer. It's D. Current ratio, quick ratio is easy, right? But in this case, they're making you do it 4 times. So if something is easy, if they have to give you the 2 marks, they're not just going to give it to you simply like that. They will make you do it multiple times. Okay. Right. So you can take this down. Those of you who have already taken it down, you can try 20.15. Drop your answers in the chat once you get it. Okay, I'm saying D. What about the others? Let me see who is in. Arundhati is also saying D. I'll read it. It's saying a publishing company is researching the reading habits of the United Kingdom's population. Okay. It randomly selects a number of locations from around the UK and then interviews everyone who lives in these locations. What is this approach to sampling known as? Okay. Right. So you're randomly selecting locations. And after you narrow it down to your locations that you want to ask questions from, you're interviewing everyone who lives there. So the moment you see that they're interviewing everyone, you have to understand that it is cluster sampling, because cluster is where you select the locations or whatever it is, the files, whatever you're trying to, research, you select it randomly. But once you come to the last stage of selection, when it comes to the final interviewing point, you will interview each and every person you narrowed down in that particular location. Okay, so that is a classic example of cluster sampling. So all of you seem to have got it. It's D. All right. Okay, 20.16. What's the company's total fixed cost? It's not a repetitive question. We don't see this kind of question often. But you can just try it out and see. I mean, you just need your general knowledge to answer this. Any answers? So this is not part of your syllabus, okay? We don't learn this anywhere in the syllabus. But you will get 1 or 2 questions like this. Everything won't be something that you learn. Okay, you have to be able to figure out about, I'm not saying half of it will be questions like this. There will be 1 or 2 questions where, it will be something new. Okay, Shakil is saying C. What about the others? Okay, let me read it. It's saying BR company has a single product with a selling price of 12 per unit, which is calculated as variable cost per unit plus 20%. Okay, so variable cost per unit plus 20%, that will give you $12. At an output level of 5,000 units, it makes a loss of $8,000. What is the company's total fixed cost? Okay. So based on what we have, it's always a good idea to write a few equations. Okay. So one equation we know is the variable cost per unit into plus 20%. No, plus 20% should give you 12. That is the selling price. But if you want to increase 20% from one number, you have to multiply it by 120%. Okay, that is normal percentages. Now, if the variable cost per unit was 5, for example, and I want to increase it by 20%, I can't just multiply it by 20. I have to multiply it by 120. Okay, so this should give me an answer of 12. Okay, so very clearly I can see I can calculate the variable cost per unit. So that will be 12 divided by 120%. Variable cost per unit. Okay, so we are talking about how much? 12 divided by 120% means 10. Okay, so of the $12 selling price, $10 is accounted for by variable cost. Okay, now if they're asking you something to do with fixed cost, right? We have the selling price, we have the variable cost. So if you want, you can find the fixed cost element. That is going to be the selling price minus the variable cost per unit that we calculated, right? So selling price is 12 minus variable cost is 10. So okay, so the fixed cost is, we're talking about $2 per unit. But they're not asking the fixed cost per unit. They are asking you the total fixed cost. So then we have to multiply this by some number of units. The only output level that we have is 5,000. Okay, so at 5,000 units, how much will the fixed cost be? So that will be $2 into 5,000, which will be 10,000. Okay, but they're also saying something else here. They're saying at an output level of 5,000, we make a loss of 8,000. Okay, that means in addition to this 10,000, we have to add our loss as well. Okay, because they are not talking about the loss alone with this 5,000 units. Okay, so we know at 5,000 units, this is the cost 10,000. But in addition to this, we are making a loss of 8,000 as well. So that loss dollar figure should also be added to the 10,000. So that makes it a total fixed cost of 18,000, which is C. Okay. You can take this down. Okay, so those of you who have already taken it down, you can try out this part. Okay, 20.17 and 20.18. So these two questions use this information. Okay, so variance analysis again. I think it's a sales variance that they want. So take your time. It take a good 4 marks here. All you need is the equations. If you have the equations, that's all you need to get these two variances. Which group was there a mock tomorrow? Let me check. Okay, I think you're talking about the, yes, yes. Wait, huh? I haven't checked the group yet. Seventeenth of May from 4:30 to 6:30, okay. But yeah, it's on the group. Yes, I know that there is a mock like this that usually happens, right? In addition to the mock that we do in class, there will be another mock paper that the management prepares. Okay. So they're saying it's from 4:30 to 6:30. Why won't you be able to join, Maisha? Because you can do it at home. It's a link, right? So it will be like a completely, there won't be papers involved. Everything will be online. Because this day was not set by me. This is usually set by the management. Okay, so if you have issues, I go to work by the time I come, it's 6. Okay, so if that is the issue, then you have to reach out to them. Okay, and see if it's possible for you to sit for it at another time. Okay. Okay, so ASIA is saying 5,200 favorable for 20.17. Okay, go ahead with 20.18 as well, because both of them, work hand in hand. 5,200 favorable, okay. And I'm assuming 800 favorable is for 20.18. Okay, what about the others? 2 of them have the answers. Anybody else? Okay, 20.18, you're saying A. Okay. By the way, that mock that they have scheduled for tomorrow is very important, guys, because only if, it's like this, right? As the management, we can't force you to do a paper until you're ready for it. Okay. So how do we decide whether you're ready or not? It is based on these mock exams. So at this point, you would have already sat for 2. So this is going to be the 3rd. So only if those marks are good enough. Okay, only if it's good enough, on our part, we can push you for the exam. Because honestly, another problem with MA is students are ready, but they are not willing to sit for exams quickly, which is a bad thing, right? I mean, it's a big problem on its own. Okay, so to avoid that, to give you confidence and actually give us also confidence to push you for your exam, that's why we have this mock. Okay, so now this is happening honestly like what, 2 weeks after we have finished our syllabus. So at this point, you should be familiar with all the theories and all the equations. Everything should be okay. Any MA paper pass rate is 50%. Any ACCA paper pass rate is 50% ASIA. So even this mock 50%. Right. Okay, so let me do the sales variances. Okay. So I don't know how many times I have told you this, but I will repeat it again. When it comes to variance analysis, what is important is the equations, right? So when it comes to sales variances, these are the equations that you need to know, right? So we have the actual, okay? Then we have the actual at standard. And then we have the standard. Okay. So for sales variances, actual will be actual quantity into actual price. And these actual and standard, it will be divided into two by default, right? So on one side, you will have actual quantity into standard price. And on the other side, you will have actual quantity into standard profit. Yes, I'll put it like this. And then in the standard box, you will have the budgeted quantity into the standard profit. Okay. So let's go through the question and put in the details one by one. Okay. So I'll just divide this also into two because this is a sales variance. So this will be divided into two. Right. The following data are available for product X. Okay. So period's budget is on this side. Period actual is on this side. Okay. So sales units budget is 5,000. Actual is 5,200. Yeah, sorry. I put actual quantity, actual quantity. Thank you, Asia. Actual quantity into actual price. Okay. Right. So sales units budget is 5,000. Actual is 5,200. Sales revenue budget is 50,000, actual 57,200, manufacturing cost 30,000, 31,200, and we have the profits 20,000, 26,000. So let's just put one by one in. Okay. So actual quantity of sales, we know it is 5,200. Into actual price, how much did we sell for per unit? We don't know that, but we know for all the 5,200 units, the total sales revenue was 57,200. So 5,200 into something will give you an answer 57,200. So you can just put the total here. Okay. Then over here, again, actual quantity 5,200 into the standard price. Okay, so what's the standard price that we're supposed to sell for? Again, we don't really know what that standard price is. Okay, but in this case, you can't just take the 50,000 and put it over here also as an answer because 50,000 is the sales revenue for 5,000 units. If you want to know the sales revenue for 5,200 units, then you have to find the sales price per unit and then multiply that with the 5,200. Okay, so the selling price, standard selling price, I put as standard per unit, that will be 50,000 divided by 5,000. Okay, so per unit, you should be able to sell it at $10. Okay, so the standard price is $10, which you will have to put here. So then 5,200 into 10, that will give you 52,000. Then on this side, actual quantity. So again, it's the 5,200 into standard profit. So from the budget, you can see the profit for 5,000 units is 20,000. Standard means we're talking about 1 unit's profit. Okay, so how you get that is 20,000 divided by 5,000. So I'll put that. 20,000 divided by 5,000, which is 4. So standard profit is $4. So we'll put that here. 5,200 into 4 will be 20,800. And finally here, budgeted quantity, we know budget and the quantity is 5,000 into the standard profit was 4. So 5,000 into 4, which is 20,000. Okay. So now we need to just get the differences. Okay. So the difference between 57,200 and 52,000 is 5,200. And here the difference between 20,800 and 20,000 is 800. Okay. So the last bit is we have to decide, is this adverse or is this favorable? Okay. So this is the sales price variance. And this is the sales volume profit margin variance. Okay. So how do we decide whether this is adverse or favorable? Okay. So we know that for this 5,200, the middle box, right? It has a little bit of standard, actual at standard, no. So it has a little bit of standard, whereas the left side box is completely actual. Okay, so this 57,200 is actual data, 52,000 is the budgeted data. Okay, so according to my budget, I'm supposed to earn 52,000. I have earned 57,200. I have earned more. If you earn more, that's a good thing. So that is favorable for you. I was supposed to earn 52,000. I earned 57,200. Earning more is always good. So this will be a favorable variance. Okay, be careful, right? When it's the sales variances, you have to think in terms of how much you're earning. Cost variances only, you have to think in terms of how much you're spending. Okay. So when it comes to these two numbers, the middle box has a little bit of actual. The right-hand side is entirely budgeted. So 20,000 is budgeted data. 20,800 is actuals. Okay. So according to budget, I should earn 20,000. I have earned 20,800. Again, I have earned more. Earning more is always a good thing. So 800 is also favorable. Okay, so price will be 5,200 favorable, which is C, and sales volume profit will be 800 favorable, which is A. Okay, so if you got those answers, good job. Okay, those of you who haven't, you can take it down. Just highlight the answers to show you where I got them from. Okay, here you don't need, if you want, you can find out. It's 57,200 divided by 5,200. If you want, I'll just get that as well. 11. Okay, take it down. Let me know once you're done so we can move on. Done, guys? Taking it down. Variances, only until you learn the equations, you'll feel like, it's a big thing, right? But once you learn it and once you start seeing the questions, you will actually enjoy it. Because unlike other areas, like for example, see the previous question, we were talking about a fixed cost. Normally, we are happy when we see variable cost, fixed cost, right? But they can complicate it. But variances, they can't complicate it. Okay, so the only thing is for you to learn the equations properly. That's it. Let me know once you've taken it down. Those of you who have, you can just have a look at this question, 20.19. Okay. Arundhati is saying A. Okay, good. Okay, so let me read the 19th one. SJC company has used linear regression analysis to establish the relationship between total cost and activity in units. So that's what everybody does, right? If it is linear regression, we try to find the equation of the line y equals a plus bx. Okay, so there we are establishing the relationship between total cost, which is y, and activity, which is x. Okay, what does the slope of the regression line represent? Okay, so I'll just write the equation here. Y equals a plus bx, right? So any line, if you're talking about the slope, you're talking about the number attached to x, in this case b. Okay, so if you're talking about the slope, we're talking about b, and b is actually the variable cost per unit. Okay, what is A then? A is the fixed cost. Okay, so that is actually the y-intercept, the point where the line touches the y-axis. Okay, so those of you who said A, I think most of you got it right there. It is the variable cost per unit. Right. So this will be the last question from the mixed bag. After this, we will move on to the mock exam. It's about residual income and return on investment. Okay, so you have to, it seems like you have to calculate both residual income, return on investment, and arrive at an answer with regard to whether it has increased or decreased. You can have a go at it. Anybody with answers? Okay, one answer B. What about the others? Increase and decrease. You see. Yes, so I think we're having mixed answers. B and no, okay, all of you are saying B. Right, so let me read it. It's very clear. Even before I read it, I know I have to calculate RI and RI most probably before and after an investment. Okay. So it's saying here a division has a capital employed of 2 million and earns an operating profit of 600,000. It's considering a project that will increase operating profit by 20,000, but will increase its capital employed by 80,000. A rate of 15% is used to compute interest on capital employed. What will be the effect on the residual income and return on capital employed if the division accepts the project? Okay, so we have to do everything one by one. Okay, so let's look at the current situation. Okay, so currently, if you talk about ROI, how do we calculate ROI? It is usually the controllable profit and controllable profit divided by the controllable investment into 100. That's the usual equation. Okay. So if you look over here, the controllable profit, it was operating profit is 600,000. And the capital employed, which is the investment, it was 2 million. So 2 million. Okay. So ROI is actually 0.3. So we need it as a percentage. So let me multiply this by 100. Okay. So we're talking about 30%. Okay. No. 30%. Okay. So now we need to calculate the RI that we have currently. So how do we calculate RI? That is your controllable profit minus the controllable investment into the cost of capital. Okay. So over here, we have the controllable profit, which was 600,000 minus the controllable investment, which is 2 million. Into cost of capital, they're telling me the rate is 15%. Okay. So when I put that in my cal, I should get the RI as 300,000. Okay, 300,000. Okay, right. So this is the current situation. Let's look at what happens after the investment. So same thing. Let's calculate ROI now. Okay. So now what happens? They're saying it will increase your operating profit by 20,000. So currently we have a profit of 600,000. That will be increased by 20,000 means it's going to become 620,000 divided by the investment. Currently it's 2 million. That will increase by 80,000. So it will become 2,080,000 into 100. Okay. So the ROI, you can calculate it. It will be 29.8%. Okay. With regard to the RI, we know now the controllable profit is 620,000 minus controllable investment 2,080,000 into cost of capital, which is 15%. Okay. So RI will be 308,000. Okay. So what has happened to ROI? ROI from 30, it has come to 29.8. So ROI has decreased. I'll just write it here. ROI has decreased. And RI from 300,000, it has become 308,000. So RI has increased. So where do we have that answer? RI has increased and ROI has decreased. So yes, the answer is B. Okay. Right. So 7:10 now. Okay, since we started at 6, I think some of you will have to pray. So let's take our break, come back at 7:30, and we'll continue with the mock exam. Okay. Okay, so I hope all of you are back. So like I said, we will be doing an entire MA styled paper now. Okay. So if my calculations are correct, we should be able to do half of this paper by the end of today and the remainder either next week or the week after, depending on whether we're having the TRG on the 23rd or not. Okay. Right. So let's look at section A. It says there, which of the following statements about spreadsheets is true? Okay. What do you think? Is it A, B, C, or D? Which of the following is true? This is a very important paper in the sense that we have a lot of areas that, other papers don't usually touch. Okay, so in that sense, it's a good paper to try out just before you do your exam. Okay. Right, so I have 3 answers. Let me see. A, okay, right. So spreadsheets can be used to depict data graphically. That's of course true. You can, right? You can put in graphs or anything in a spreadsheet. So that seems to be correct. Anyway, I'll read the rest. Spreadsheets cannot be used for sensitivity analysis. That's wrong. They can be used. The formula B5 equals B5 plus B6 plus B7 can also be represented by the formula sum B5 is to B7. Actually, the formula itself is correct. Okay, but before this sum, there has to be an equal sign. Okay, if the equal sign is not there, then it is not a formula. So that is why C is wrong. Okay. The formula equal sign 9 to the power 2 will give the answer 3. 9 to the power 2 means we're talking about 9 into 9. 9 into 9 is not 3, right? So this is also wrong. So the answer there is A, correct. Second one, which of the following describes the purposes of mission statements? What is sensitivity analysis? Okay. Right. So let me explain this since we have the spreadsheet here. I will explain sensitivity analysis. Thank you. Okay. If you have questions like this, bring it up. Sensitivity. Okay. So to explain what this is, usually this is used when we calculate NPVs. Okay. So let's just calculate a normal NPV situation. Okay. So usually we will have the years. Let me just put 0, 1, 2, and 3 years. Okay. Let's say the initial investment. Okay. The initial investment, let's say it was minus 50,000. And then let's say the cash flows. Okay. In year 1, it was say 100,000. Year 2, it's 200,000. Year 3, it's 250,000. So I'm just giving you a normal NPV calculation. Okay. So now if I were to calculate NPV, what will I do? I will get the net cash flow here. Again, in this case, there is only one cash flow. So this will be minus 50,000. Okay, and all of this, I'll just copy it here. Okay. Then what will I do? I will take the discount factor. Let's say the cost of capital was 10%. So discount factor at 10%. Year naught is always 1. Then here it will be 0.909, 0.826, 0.751. Okay. Then what will I do? Underline this also, and I will get the present value at 10%. Okay. So that will be 50,000 into 1. This will be minus 50,000. Here it will be 100,000 into 0.909, which is 90,900. Likewise, you can multiply 20,000 by 0.826 and 250,000 by 0.751. Okay. Then you can get the NPV, which is simply the addition of all the present values. So sum, you can open a bracket and just highlight all the cells. So the NPV is a positive 393,850. Okay. So this is a normal NPV calculation. Okay. So what is sensitivity analysis, right? So the situation is this. Can you see there are certain figures here that we have predicted. these cash flows, right? We have predicted that there will be a cash inflow of 100,000 in year 1. We have predicted that there is a cash inflow of 200,000 in year 2 and 250,000 in year 3. Okay. Now, the fact is, any prediction, it can go wrong because it's something for the future. No? So, we can't predict 100% accurately. Okay. So, let's say somewhere in like year 1, we realize in year 3, we are not going to get 250,000. Okay, and maybe even in year naught, we realize this. Okay, we have done this calculation, but there is a chance that we won't get 250,000 in year 3. Okay, now what are we interested in? We are interested in knowing, okay, what will happen to NPV if we don't get this 250,000? Okay, so let's say we can't get 250 in year 3. We have now predicted we can only get 180,000 as a cash inflow. What will happen to NPV? Okay, so now if this was done manually, guys, you have to do the entire calculation over again, right? But here, because everything is formulated, all you have to do is, okay, instead of 250, we are going to get 180, no? So you just put 180,000 there. Okay, so then what happens? Okay, let me just, since this was copied, this will also become 180,000. Okay, then you can see, since everything is formulated, immediately this present value figure changes and this NPV figure also changes. Okay, so I can see, okay, if my cash inflow in year 3 reduces to 180,000, NPV is 341,280. In this case, it's still positive, so we don't have to worry about it. Okay, I'll just come up with something else. Let's say in year 2, we realize that it's not going to be 200,000. It will end up becoming 10,000. Then what happens to NPV? You can see it is dropping to 184,340. Okay, so likewise, I can keep on changing any of these input figures. I can check what will happen if this is 60,000. Okay, what will happen if my investment increases? It becomes minus 100,000. Okay, so I can make any change that I want and I can see what is happening to this NPV figure. Okay, so sensitivity analysis means what are we trying to analyze? How will NPV change if one of these input variables change? Because if one of these input variables change and the NPV becomes negative, then we can't go ahead with that particular investment. Okay, so for example, let's say we know that this 50,000 is going to become minus 1 million, just saying. Then very clearly you can see that this NPV is becoming a negative 802,020. So that means you know that you can't have an investment of 1 million and expect to make a profit out of this project. Okay, so the advantage of a spreadsheet is you can just simply change the numbers and see what's happening to NPV as opposed to when you do it manually, because then you will have to do this about 10 times every time you change the input figure. Okay, so that's the advantage of spreadsheet. Since everything is formulated, it's easier for us to do sensitivity analysis. Okay. Right. So, good. Right. So, let's look at the second one. Which of the following describes the purpose of mission statements? No problem, Arunda. What's the purpose of mission statements? To help customers understand the purpose of the organization. Okay, so first get this very clear, right? A mission statement is written when you start an organization, when you start a business, the founder ideally will write the mission statement. Okay, so in this statement, he mentions what exactly he wants to gain out of this organization. Okay, so definitely the first point, which is to help consumers understand the purpose of the organization, that is true because that is what we are trying to write in the mission statement. Why have we started this particular business? Okay, so first is correct. Two, to comply with government regulations, there are no regulations to have mission statements. If you want, you can have. If not, you cannot have. There is no hard and fast rule that every company has to have a mission statement. So 2 is wrong. To guide the actions of the organization, that is true. Because if you have the mission statement, you have a clear picture of why you started this organization. So down the line, maybe 5 years, 10 years down the line, when you are taking decisions for the organization, you can cross-check with the mission statement and see, are we still in line with our original mission? Or have we deviated? If we have deviated, how can we come back? Okay, so it acts as a guide throughout the life of the organization. So 1 and 3 is correct. So the answer there, like she said, is B. What do you think is the third one's answer? One and two. Okay, so we have A and D. Some are saying 1 and 2. Okay. Top-down budgets. Okay, so what's a top-down budget? Senior managers, they make the budgets and they enforce it on the junior managers. Basically, it is the traditional sense of budgeting, right? That's how we used to do things traditionally. Whoever is at the top will create the budget and they will tell the juniors, stick to this budget, right? So what are the true statements with regard to that? There is little or no input from operating staff. That is true because operating staff is at the lower levels, right? So they are the junior people in the organization. If it's a top-down budget, they don't generally have a say in the budget. So the first one is correct. They are effective in large organizations. Okay. So with regard to large and small, we don't really talk about budgets in terms of the size of the organization. Okay, because depending on that particular organization's job and now, for example, if this organization was to do with manufacturing, then maybe top-down budget will be good. But if it is a service-related organization, then it might be better to have a bottom-up budget. So with regard to the size and the budget, they don't really match. Okay, so the second point doesn't make sense. They improve team morale. Team morale means basically how the juniors feel. Okay, so if you have a top-down budget, seniors are telling you do this. Chances are that it won't improve their morale. It will actually take a hit because they don't have a say in the budget that they are supposed to follow. Okay, so C is not true. They are relatively quick to produce. That is true. Because C, senior will make it, they will send it to the juniors. That's about it. Okay, but if it is a bottom-up budget, bottom-up means it's the opposite. The juniors make it, they then send it for approval to the seniors. Seniors will approve it and then send it back to the juniors. So you can see it is like a circle. So bottom-up budgeting anyway will take time because the senior manager has to look at what the junior manager has prepared, see if he's happy with it, make changes if required, and then send it down to the junior manager. So that tends to be a little slower. Okay, so top-down budgets are quick to produce. So D is also an answer. So it will be A and D. Which two of the following would be shown in an operating statement prepared under standard marginal costing system? Which two of the following will be shown in an operating statement prepared under a standard marginal costing system? C and D, okay. What do you all think? The others? Okay, so let me summarize this for you, right? There are two types of costing. We have absorption and there is marginal. When it comes to variance analysis, there are only a few differences between absorption and marginal. So what are those differences, right? First is in absorption costing, you have a fixed overhead volume variance. Okay, first is this fixed overhead volume variance. If you have a fixed overhead volume variance, automatically this volume variance can be split into two, and you can get what we call the fixed overhead capacity variance and the fixed overhead efficiency variance. Okay. In addition to that, if you have absorption costing, you will calculate a sales volume profit variance. Okay. Over here, you won't calculate sales volume profit. You will calculate a sales volume contribution variance. Other than that, the differences are, when it comes to marginal, you will not have fixed overheads volume. If you don't have fixed overhead volume, automatically this capacity and efficiency also can't be calculated, because capacity and efficiency is a breakdown of the fixed overhead volume variance. That's the only difference between absorption costing and marginal costing. So they're asking, what will you have in marginal costing operating statement, right? So will we have fixed production overhead efficiency? Definitely not, because that is only there under absorption costing. Definitely you won't have a fixed overhead capacity also, because that is also there only under absorption costing. A fixed production overhead expenditure will be there. Okay. So if you remember, fixed overheads can be divided into two, expenditure and volume. Okay. Expenditure is there for both absorption as well as marginal costing. Sales volume variance, definitely you can have it, right? Sales volume, it will be called the contribution. They haven't mentioned whether it is contribution or profit. So definitely this can also be included. So the answer will be C and D. Okay. You can try out the fifth one. Budgeted results and actual results for September are given. They're asking, what is the profit for a flexed budget? I'll give you a few minutes, because I feel there are some of you who haven't tried it out as well. If you haven't tried it out, try it out and see. Okay, so what's a flexed budget, right? So that's the first question we have to ask. So it's like this, right? When you have an actual budget, 1 second, I think it says, actually there's a small mistake in this question, right? It's not supposed to be flexed budget here. It should say fixed budget. Okay, I'm sorry, I just saw that. They're asking you to calculate the profit for the flexed budget. Okay, so this is not the flexed budget, obviously. If not, answer will be 26,000. No, they're asking for the profit for the flexed budget. So this is actually called the fixed budget. Okay, so what is this flexed budget, right? Fixed budget means the budget that you originally prepared. So in this case, we have originally prepared for 2000 units. Okay. But now the issue is, actually we have not made 2000 units. So now we are not in a position to compare this actual with this budget, because the number of units is different. Okay. So the only thing that we can do, and after that we can do the comparison, is to prepare something called the flex budget, where we convert this original budget into a flexed budget, meaning the only change we make is, instead of making 2000 units, we change it to 1700 units. Okay. So in this case, let's look at how the flexed budget will look like. Okay, right. So in the original budget, you are expecting to sell 2000 units. In the flexed budget, we put the actual units that we sold, which is 1700. Okay. Then we look at the sales. So with regard to the sales, we are expecting $60,000 if we sell 2000 units. That means per unit, we are thinking about 60,000 divided by 2000. Per unit, we are thinking about a selling price of $30, right? So for 1700 units, we will be expecting 1700 into 30, which is 51,000. Okay. Then we can look at the direct cost. Okay. So with regard to the direct cost, we are expecting to spend 24,000 for 2000 units. So per unit, we're expecting to spend $12, right? So for 1700 units, it's going to be 1700 into 12. It will be 20,400. Okay, this is a negative figure. Okay, let it just be there. I will formulate it later. So 1700 to 12. Okay. Then we have the fixed cost. Fixed cost, of course, regardless of the number of units that you produce, it can't change. That's the main thing about fixed cost, right? Regardless of the activity level, it doesn't change. So if we budgeted it to be 10,000, even in the flexed budget, we have to keep it as 10,000 only. Okay. So now we can get the profit, which will be 51,000 minus 20,400 minus 10,000. So that will be 20,600. Okay. So 20,600 means the answer is B. Not 22,100. Okay. If you got 22,100, how did you get it? You must have taken the fixed cost as something else, right? Okay, so careful there. Fixed cost. Okay. Variable cost only will change depending on the number of units. Okay, fixed cost, whether it is 2000 units or 1700 units, if you budgeted it to be 10,000, it should be 10,000. Okay, we don't even take the 9,500. For some reason, it has reduced, but that is something that has caused the variance, right? So the flexed budget shouldn't reflect any of the actual data. It should reflect the original fixed budget data. Okay. Okay, so if you have taken this down, you can try out the sixth one. Which of the following control actions could be used to eliminate an adverse direct labor efficiency variance? Again and again, you can see the amount of weightage that's given for variance analysis, right? So like I always say, easily about 10 to 15 marks of your paper will be from variance analysis. So please familiarize yourself with variances. Okay, they can ask you to do calculations, and they can ask theory based questions like this one, and both will come, right? Some areas of the syllabus you will only get theory or only calculation, right? But variances, sure shot, you're going to get both. Okay. B. Okay, let me see, right? Which of the following control actions could be used to eliminate an adverse direct labor efficiency variance? Adverse direct labor efficiency means your people are working faster or slower. If it is adverse, meaning it's bad for me. So what is the situation? They are working slower than what I budgeted. So how can I make them fast, basically, right? So first thing, recruit more highly skilled labor. That might work. Because the more skilled your laborers are, the faster they will be. So you might achieve your speed by recruiting better skilled labor. So one definitely can be the answer. Purchase cheaper materials. Okay, now if you buy cheaper materials, guys, think about it. There will be a lot of wastage. Okay, it will take time to properly, like say for example, you're buying wood and it is cheaper. There is a chance that there will be a lot of pieces in the wood that you can't use, right? So what will happen? Your laborers, when they are cutting it, they will have to, properly look at the material and make sure that they discard the pieces that are not usable and select only the pieces that can be used. Now, doing this, filtering the good material and the bad material on its own, it will take some more time, right? So the problem we are trying to fix is the fact that our laborers are slow. If you go and buy them cheaper material, they're going to become even more slower, right? So second one is not going to help the situation. It will actually make it worse. Third one, check that the standard is accurate. Actually, that is true. Okay, because sometimes we might say take 1 hour to make one desk. That is our standard. But maybe in the current situation, in the current context that the company is running in, they can't do it in 1 hour. It's impossible. So check if actually it can be done in 1 hour. If it can't, then maybe a better option will be to adjust your standard. Okay, so any variance, checking the standard will always be a correct answer. Okay, so 1 and 3, which is B. Okay, try out the 7th one. Again, a very, very common question. At this point, we have done quite a lot of it in the TRG itself. B. Okay. What about the others? 7 of you. I have 2 answers. Anybody else with an answer? Take your time. It's fine. Okay, so let me read it. It's saying, in a period, opening inventories were 12,600, closing inventories were 4,100. The profit based on marginal costing was 50,400 and the profit based on absorption costing is 60,150. Okay, now usually they ask us to calculate absorption costing profit and they will give us marginal costing profit. Or the other way around, they will give us absorption and ask us to calculate marginal. But here both are given. Then what are they asking us to calculate? They are asking us to calculate what is the fixed overhead absorption rate per unit. They are asking to calculate the OAR. Okay, so don't panic, okay, when you see something like this. The area is the same. It's just that the figure that they're asking is a little different to what we usually calculate. So first things first, write equations that you know. Okay, so we know the difference between absorption costing profit and marginal costing profit is the change in inventory into the OAR. Okay, so what do we know now? We know that the difference between marginal costing and absorption costing is basically 60,150 minus 50,400. Very clear to us, right? So we can calculate the difference very simply over here. 60,150 minus 50,400. That is only the difference between marginal costing and absorption costing, right? So we'll put that there. 9,750. That should equal to the change in inventory. That also is very clearly given. We know opening inventory is 12,600. Closing is 14,100. So what's the change in inventory? That is basically 14,100 minus 12,600, which is 1,500. So change in inventory also we have now. 1,500 into the OAR. So they want OAR. We have only OAR to find in this equation. Okay. So if we want to get OAR, all we have to do is take the 9,750, divide it. Okay. Divide it by 1,500. Okay. And that will give you the OAR. I'm just rearranging the equation. Okay. That will give you the OAR. So 9,750 divided by 1,500, the OAR is 6.5. Okay, so I think we had that answer as D. 6.5 is D. Okay, so always when you identify which area this is coming from, write down all the equations that you know and fill in whatever they have given you. Okay, most of the time it will make sense after the equations are written. Okay, so don't think, okay, why we have both marginal and absorption. They're asking OAR, how am I going to do it? Okay, it will be the same equation. It's just that they might probably ask you to work backwards. Okay, right, you can try out 8. It's actually a little long. Take about 5 minutes even, and try to figure out what the answer will be for 8. Okay, so I'll give you 5 minutes exactly. You can try it out. Yeah, she is saying, see, do we have any other answers? Take your time, guys. It's fine. Because this question, it teaches a very, very important lesson with regard to MA. Okay. Okay, so it's been 5 minutes. Let's try this, okay? LG is in the process of setting standard costs for the next period. Product F uses two types of materials, M and N. Okay, so let's just type it as we, go through, right? So we know about our materials. There are two materials apparently. One is M. Okay, so what about M? They're saying 6 kilograms of material M and 5 kilograms of material N should be used. So 6 kilos of M and 5 kilos of N should be used at a standard price of 2 per kilo and 3 per kilo respectively. So here we're talking about $2 per kilo, and here we're talking about $3 per kilo. Okay, so we can take totals here. 6 into 2 will be 12, and here 5 threes are 15. So if you want, on the side, we can take 12 plus 15, which will be 27. Okay, so that's about the materials. Then they're saying 3 hours of skilled labor and 1 hour of semi-skilled labor will be required for each unit of F. Okay. Wage rates are 8 per hour and 6 per hour respectively. So we have skilled labor, which is how many hours we need to spend? 3 hours. And we will pay them $8 per hour. Okay, so that will be a total of 8 into 3, which is 24. And semi-skilled, okay, semi-skilled labor, there we need to spend 1 hour, right? So 1 hour, and how much are we paying them per hour? $6. So here it will be a total of 6. So 24 plus 6, that is a total of 30. Okay. Then what are they saying? Production overhead is to be absorbed at a rate of 4 per labor hour. Okay, so let me put production overheads here. Now careful, they're saying $4 per labor hour. They are not mentioning whether it is skilled labor or semi-skilled labor, right? So that means you have to consider both. So we are taking 3 hours of skilled labor, 1 hour of semi-skilled labor. So a total of 4 hours of labor is used for this product F. Okay, so 4 into 4, that will be 16. You can just take the total here. Okay. Then they're saying 10% is to be added to the total production cost to absorb administration, selling, and distribution costs. Okay, so to this production cost that we have, that is 27 plus 30 plus 16, we can take a total. That will be 73. So to this 73, 10% has to be added. Okay, so if you want, you can see that will be 7.3. Okay, so if you want, I'll just write it here. Admin, selling, distribution. Okay, so here you will take 10% of 73, which is 7.3, and that will give you the total cost, which is 73 plus 7.3, which will be 80.3. Okay. Now, you might be tempted to select D because the answer is also there. 80.3 is also there, right? But careful. The question is asking you, what is the standard cost of production? Okay. So, if we want the production cost, we can't be including admin, selling, and distribution. Okay. Production cost is before that, right? So, if you want production cost, we're talking about 73, which is C. Okay, so the answer will be 73, which is C. So what I was telling you, the important part here is when in your MA question, you should always read the question carefully because there are two areas where you can get caught in this question, right? One is the fact that they're asking you production cost and not total cost. And in fact, they have given total cost as one of the answers. So it's very easy for you to select 80.3 incorrectly. Okay. Another area where you can get confused is the production overhead, right? They're just saying per labor hour. So some students, they might just select, 4 into 3 hours because that's the skilled labor. But remember, there was 1 hour of unskilled labor as well. So you have to take the entire 4 hours, right? So these two areas, easy to make mistakes. And even if you make that mistake, you will realize that the answer that you get, it will be one of these answers here, A, B, C, and D. Okay, so always read the question carefully. There might be extra information, like in this case. This entire line, this 10% line is entirely extra information that you don't need for this particular question. Okay. Right, so that is the 8th one. The answer will be 73. Okay, so let's see. 9. What's the value of the abnormal loss in June? What do you think it is? Process costing. I have always told you, when you're doing process costing, especially this normal loss part, always follow that table or a structure that I have given. If you don't follow that structure, especially in this question, there is a very good chance that you won't be able to get this value. And actually, now that I see it, I think this is the first time you might have seen this particular question. It used to be very common in the past. Now also it is still examinable, but because they removed a lot of areas, they tend to not question it much. Okay, but still we don't want to take the risk. Can try it out. It is part of the syllabus. Okay, this is not the area that was removed. It's just that ever since they removed an area from process costing, they are kind of not questioning much with regard to process costing. But this is still part of the syllabus. Okay. So we have an answer for 9. Take your time. Okay, take as much time as you want, because this is an area where you will be able to do it only if you understand the concept of process costing completely. Okay. Okay. Okay, stuck. I hope at least you guys have given a start. Okay, at least start this. The value of the abnormal loss, fine. At least do you have a value for how many kilos, or was this kilos? Units were input. Okay. Do you have a figure for how many units was abnormal loss? That part you should be able to calculate. No? Value, okay, that is separate. How many units of abnormal loss did we have? Do you have that figure? No? That part is normal. Okay, 300, right. So at least you know how to get that point, right? Okay. So I feel you guys are stuck. So let's start, okay? Always process costing have this structure, right? Units and dollars. Always you have to have a column for units and a column for dollars, right? So now put in whatever data you have. They're saying a manufacturing company produces a product that has to pass through two processes, process 1 and process 2 before completion. In process 1, 10% of input is lost via evaporation and all good output is transferred to process 2. Okay, so we are talking about this process 1 only, where 10% of your units are lost. In June, in a particular month, 200 units were input to process 1 at a cost of 6.5 per unit and conversion costs were 5,000. Output transferred to process 2 was 1,500 units. What's the value of the abnormal loss in June? Okay, so let me write down whatever we know, right? So we are talking about June. What has happened here? We have a particular input. Okay, that was 2,000 units. Okay, we had 2,000 units of input. And each unit, we value it at $6.5. That's what they're saying, at a cost of 6.5 per unit. So the dollar figure is basically 6.5 into 2,000. We're talking about 13,000. So I'll just write down how I got that as well. How did I get 13,000? 6.5 into 2,000. Okay. Then they're saying conversion costs are 5,000. Conversion cost means it's labor plus overheads. Okay, so in case you didn't know that so far, conversion cost means any labor plus overhead. So instead of saying labor separately, overhead separately, we can put it together and call it a conversion cost. Okay, so they're saying that is 5,000. So we put that here. Okay, then what do? We have to, at this point, take totals, right? So let's just draw a line here. Okay. Right. So now you can take a total here. In terms of units, we're talking about 2,000. And here, 13,000 plus 5,000, we're talking about 18,000. Material is not conversion, right? Conversion cost is only labor plus overheads. Okay, so remember that. Conversion means we're talking about labor and overheads only. Okay. Right. So now we'll talk about the normal loss. Okay. What is happening with regard to the normal loss, right? They're saying 10% of input is lost via evaporation. Okay. So we need to include that here. So normal loss 10%. Input was 2,000 units. So if you're talking about 10% of 2,000, that will be 200 units. That was the normal loss. Okay, I'll just put it as a negative. Okay. And is there a value? So usually if the normal loss can be sold at a scrap value, then you can multiply the scrap value into 200 and put it here, right? But in this case, it is lost via evaporation. That means obviously it's evaporating into the air. You can't sell it for any amount. Okay. So there is no value for these 200 units that you are losing, unfortunately. Okay. Can take a total here. We call this the expected output, right? So this is expected output. So how much? 2000 minus 200, that's 1800. And here $18,000. Okay. Now what was the actual output? Actual output. Here we don't have it as output, but we know that output transferred to process 2 was 1500. So we know that this was 1500. Okay. Now we expected to send 1800 into process 2. We have only sent 1500. We have sent less. That means obviously we have lost more than what we predicted. There is an abnormal loss situation. How many units were lost abnormally? 1800 minus 1500. So that is 300 units is the abnormal loss. Okay. But that is not the question. The question is asking you, what's the value of this 300 units? How much can you value it at? Okay. Now remember, this abnormal loss is always valued at the full cost per unit. Always valued at the full cost per unit. So how do we get the full cost per unit? You will have your 18,000. Okay. So the full cost per unit, I'll write it here. It's your 18,000, which is the cost, divided by the expected output, which is 1800. Okay. So the full cost per unit is actually $10. Okay. So the value of this abnormal loss, it will be 300 units valued at $10 per unit. So that is 3,000, which is B. Okay. Let me know once you've taken this down. Okay, if you're done, you can try the 10th. So let's, have you guys taken it down? Okay, since I think most of you might not have got it. Okay. All of you have taken it down. Let's look at the 10th one. Okay, so it's saying the following information relates to the machining department of a manufacturing organization. We have the budgeted machine hours, the budgeted overheads, actual machine hours, actual overheads. Overheads are absorbed on the basis of machine hours what was the total over-absorption of production overheads for period 1? Okay, so they're asking you to calculate an over-absorption. Let me know once you have answers for the 10th one. $380,000. Check again, Asya. Okay, so this is a classic over under absorption situation. All right, so let's see. You all have taken this down, right? Can somebody confirm? I only got about 1 or 2 dones because I know most of you might not have got this. Okay. Just take the silence as a yes. Usually I take the silence as a no. I take it as a yes this time. And let's continue. Okay. Right. So if you want to get an over or under absorption, you have to compare 2 things. You have to compare the actual overhead with what you absorbed. So the absorbed overhead. Okay. Now actual overhead, it has to always be given in the question. Unless they're asking you to find actual overhead, it has to be given directly, which they have given here, 350,000. Okay. So you can put that directly. Now, absorbed overhead, always remember, it is calculated using this formula. It's the OAR into the actual hours. Now, in this case, actual machine hours. Okay. So, how do we calculate OAR? Now, OAR is always calculated using budgeted figures. Okay. So, the OAR will be calculated using budgeted figures, and that OAR will be multiplied by the actual hours. Okay, so how do we calculate OAR? Okay, that is always the budgeted overheads, in this case, divided by the budgeted machine hours in this case. Okay, so the budgeted overhead, that is, budgeted overheads is 400,000, right? So 400,000 divided by the budgeted machine hours, which is 20,000. Okay, so 400,000 divided by 20,000. Okay, so the OAR will be 20. Okay, so the OAR is 20. So if you want to calculate the absorbed overhead, all you have to do is take 20, which is the OAR, and multiply it with the actual machine hours, which was 19,000. So 20 into 19,000, that is 380,000. Just put it. Okay, 380,000. So now if I take the difference between these two numbers, I will be able to get the under or over absorption. Okay, so in this case, they have already told me that it is an over absorption, so I don't have to think too much. Just take the difference between the two numbers. So 380 minus 300, which is 30,000. Okay, so how do I know it's over absorption? It's given in the question, but even if it wasn't given, you should be able to figure it out. Okay, so you can see that actual overhead is 350,000. So that is how much I should have absorbed. Okay, but I have gone and absorbed 380,000. I have absorbed more. If you absorb more, that is over absorption. Okay, so the answer there will be 30,000. The key here is this equation. Don't ever forget this, right? OAR is always based on budgeted figures. Okay, so the calculation will always be based on budgeted figures, and that then will be multiplied with something that is actual in nature. In this case, actual hours. That is the key. This is the area where people usually go wrong. Okay. Right. You can take it down. Those of you who have taken it down, you can try out the 11th one. Any OAR, right? Not just here. Any OAR can be calculated using budgeted figures only. Do you have answers for the 11th one? Okay, 2 and 4, C and D, B and C. Okay, I have all the letters of the alphabet. Right, let's see. Which two of the following situations would help to explain a favorable sales volume variance? So sales volume is favorable means I expected to sell maybe 200 units. I sold more. Okay, so situation is I have sold more. Which of these will result in you selling more, right? Let's see. Increased competitive activity led to a reduction in the number of units sold. That is wrong. Because it's a favorable sales volume means I should sell more, not reduce the number of units I sold. So that's wrong. B say customers were given discounts at a higher level than standard in order to encourage increased sales volume. That seems to be right, right? If you give them a discount more than the standard, then what will happen? You will end up selling more units. If you sell more units, your sales volume will be favorable. So B can be an answer. The unit cost of production was lower than the standard and selling prices were maintained at the standard level, so that a higher profit was achieved per unit sold. With regard to the sales volume, guys, we are not concerned about profit. We are just concerned about the number. Okay, because if you see, I think we did a sales variance today. Let's see if I can find that equation. Yeah, here see, sales volume variance, you can see this profit is constant between these two. So profit is not the thing that is changing. What is changing is just the quantities. So we are just concerned about the number of units that we are talking about when we are talking about the volume variance. Okay, so definitely nothing to do with price or profits. So it can't be C. Okay. Then finally, higher quality material supplies led to improvements in quality of the final output, which customers found attractive. Seems to be right. If people are attracted to your product, they think it's a good quality product, definitely your sales volume will increase. Okay, so that can also cause a favorable sales volume variance. Answers will be 2 and 4 or B and D. Okay. Okay, then it says a company has identified two mutually exclusive projects which have an equivalent effect on the risk profile of the company. Mutually exclusive means if you're doing project 1, you can't do project 2. If you're doing project 2, you can't do project 1. You have to select one of the two. They're giving you the discounted payback period, net present value, IRR, return on investment, and the cost of capital. They're saying, assuming that the directors wish to maximize shareholder wealth and no shortage of capital is expected, which project should the company choose? B. Okay. What about the others? B. Others, do you have answers? Okay, so there are so many investment appraisal techniques. They have given you, I think, almost everything that we have learned, right? Payback, NPV, IRR, return on investment. Only thing that is not there is actually RI, but RI is not an investment appraisal technique. So actually everything is there. Okay, but remember, regardless of how many numbers you are given, okay, the only method that is superior to everything else is NPV, net present value. Okay, so if you have so many information about payback, IRR, ROI, so many things, don't think about anything else. Just look at the NPV. Okay, if the NPV is positive, accept. If not, reject. That's it. Okay, so here they are asking you which project can you choose. Okay, one is because they're saying A part, one because it has a shorter payback. We don't take the decision based on payback, so that's out. 2 because it has the higher NPV. So let's look at project 2. NPV is 18,700. Project 1 is 17,200. Both are mutually exclusive. Okay, now, yeah, we don't have a shortage of capital, but we can't do both project 1 and 2. Okay, because mutually exclusive means you can either do 2 or 1. So in that case, you will obviously choose project 2 because it has the higher NPV compared to project 1. Okay, so B is actually correct. See, I'll just read it. 1, because it has a high IRR. We don't care about IRR when NPV is there. And D, they're saying both projects because they both have a positive NPV. Actually, the point is correct. Both are positive. So you can choose both. We don't even have a shortage of capital. But because they are both mutually exclusive, we can't do that. It's not possible. Mutually exclusive means you can only do one of the two. So choose the one that gives you the higher NPV. So the answer there will be B. Okay. 13. Which two of the following would be part of a capital expenditure budget? C and D. Maintenance and replacement, you say. B and D. All of you are saying refurbishment and I had a C and D also. So definitely all of you are agreeing with D, replacement, right? So let's see, which two of the following will be part of capital expenditure? Capital expense means only two things, right? One is when you're buying a non-current asset or you're improving the earning capacity of a non-current asset that you already have. So purchase of raw material is inventory, that is not non-current asset. So A is definitely out. Two, refurbishment of existing factory premises. Now factory is a non-current asset. Okay, refurbishment means I am doing something that is going to improve the factory. Okay, now if the factory improves, definitely your earning capacity will improve, right? Now maybe you only had 2 rooms, you made a third room. Refurbishment, you did something. Now there is a third room. So if you were able to only do 1,000 units because of 2 rooms being available, now the third room will increase your inventory that, I'm sorry, the raw material, finished goods that you can make. Right? So refurbishment of existing factory, it will improve your earning capacity. If it's improving earning capacity, it is capital expenses. So B is an answer. Annual maintenance cost of existing asset is a classic example of revenue expense. Maintenance, right? So we are not improving the earning capacity. We are just making sure that the asset doesn't break down. So C can't be an answer. D, replacement of existing machinery, that is straightforward. Definitely, that is capital expense. Okay. So the answer there will be B and D. Okay. 14th one. What are the 5 V's associated with big data? Okay. So this you have to know it. If you don't know it, you will have to guess it only. So the 5 V's are volume, velocity, variety, veracity, and value. Okay. So let me see where that is. Volume, velocity, A is visibility. So this can't be there. Verification is not there. Value, volume, velocity, variety, veracity. Okay, so this is the one. C. Can't be D also because there is no verification. Okay. Right. Fifteenth one is to do with something to do with the seasonal variation. Okay. Trend, we're seeing trend, seasonal variation. So mostly we're talking about a time series analysis. Okay. Saying C. So that is 1,757. That's what you're saying. Okay. What about the others? Remember, they're asking for forecast sales value for the first quarter of year 10. So forecast sales means you have to consider trend plus seasonal variation. You can't just consider the trend alone. So I'll just make this actually, the fact that it's given horizontally is not making it very clear, right? So I'll just type the same information, but a little differently. Okay. So we have year 7, okay? And we have quarter 1, quarter 2, quarter 3, quarter 4, okay? Then we have year 8. Again, the same thing is there, okay? So what are they saying here? Okay, they're saying the trend figures are this, because it's saying a sales analyst has established the following trend figures and seasonal variations for a company's sales. So these are the trend figures, right? So in year 7, quarter 1, it's 1,500, then 1,528, then 1,552, 1,530. I'm doing in thousands, okay? Then for year 8, 1,557, 1,580, 1,608, and 1,632. Okay. And we know that seasonal variations are also there. Okay. So seasonal variation, if you are talking about year quarter 1, it will be minus 18,000. If not, it will be 3. It will be 29 plus 29, or it will be again minus 14. Okay. These are the seasonal variations. It will keep on repeating year after year. The question is asking you, what is the forecast sales value for the first quarter of year 10? Okay, so if I want to know the first quarter of year 10, I have to figure out what is the trend, what is the seasonal variation in that quarter, and then basically put them together. So about the trend, they're saying the analyst forecast that the trend will increase by 25,000 per quarter in years 9 and 10. Okay, so that means if this is year 9, quarter 1 to quarter 4, right? This number is going to increase by 25,000. Since I'm doing it in thousands, it will increase by 25, right? So this will be 1,632 plus 25. Okay, so this will be 1,657 plus 25. This will be 1,682 plus 25. And here it will be 1,707 plus 25. That's the trend. Okay, and the seasonal variations, it will be the same. Quarter 1 means it will be minus 18. Quarter 2 means it will be 3, 29, and minus 14 for quarter 4. Okay, so that is year 9. Then let's go to year 10. What are they saying? Quarter 1, that's what we want, right? So let me bold this. This is the quarter that we want. So again, this 1,732, it has to increase by 25. So it will become 1,757. But we can't stop there. Okay, why? Because quarter 1 means there is the seasonal variation of minus 18. So you can't exclude that. You have to include that minus 18. Okay, so overall, your forecasted sales, okay, that will be your trend plus your seasonal variation, right? So trend plus seasonal variation. So we know that the trend is 1,757 minus, now in this case, since it's a negative 18 plus seasonal variation will end up becoming minus 18. Okay, so 1,757 minus 18, that is 1,739. 1,739, that is B. Okay, so the answer will be B. So forecasted sales in year 10, quarter 1 will be 1,739. Is that clear? Okay. So in your exam, you might ask, okay, should I do it this way? You know, like do all the quarters and then, do the subtraction, right? You don't have to, right? I'll show you how to do it in a shorter way as well. Okay. We know that the last figure that we have in terms of trend is 1,632, which is a quarter 4 figure for year 8. Okay. Now we want to come to year 10, quarter 1, right? So in year 8, all the quarters have finished. Year 9, there are 4 quarters. Quarter 1, 2, 3, and 4. Plus another quarter in year 10. So altogether, there are 5 quarters that we have to predict. Okay. So we know that every quarter it will increase by 25,000. So for 5 quarters means we have to increase our trend figure by 25 into 5. Okay, so by 125. So this 1,632, it should increase by 125. So that will give you your 1,757. From this figure, we should know it's a quarter one prediction. Quarter one means seasonal variation is always minus 18. So that will give you your final answer of 1739. Okay. So the only thing is you should be able to understand that between year 8 quarter 4 to year 10 quarter 1, there are 5 quarters. Each of them, the trend will increase by 25,000. So altogether, this 1,632 should increase by 125. Okay. So that way you will get the same answer much fast. All right. So yeah, we're done with 15 questions. I think that's good. Next one is a variable production overhead efficiency. Okay. So it's a variance question. I don't want to start that now. Let's call it a day today. I'll see you at the next TRG. I think it won't be next week. Most probably it will be on the 30th. Okay. But anyway, watch out on the group on that day, on the 23rd. Just make sure that you have a look at the group and confirm whether or not the TRG is happening or not. Okay. So either way, whenever we meet next, we will finish off this mock paper. Okay. No problem, Aisha. Is that the last class? Okay. So yeah, anyway, you will only have 4 classes. TRG is only for 4 classes. So either it will be the 23rd or it will be the 30th because we can't have 5 TRGs now. Okay, but in my, I feel it won't happen on the 23rd because it is a big holiday. Now that's the Vesak holiday. So people might not be able to join. So many things will be there. So most probably it will happen only on the 30th. Okay, because always TRGs only go on for 4 days unless there is a very rare situation. Okay, like for example, I think, was it the last TRG or the one before that, we had 5. But the reason why that happened was, I think there were a lot of students who were very weak with variances. Okay, so on one day, I just thought, never mind, even if it's one class, I taught variances from the beginning. Okay, because I know if you don't know variances, you will have a big problem. But I don't see that issue happening here. Okay, so in this case, we will anyway only have 4 TRGs. Okay, right. So that's it for the day. I will see you either on the 23rd or the 30th, right? No problem. Have a nice week ahead.